Good morning, everyone, and welcome to the second lecture of the Felesky Flynn 2021 Tax School series on corporate M&A transactions. This morning, we will be discussing some common tax issues in planning the transaction structure. But before we get to that, just a few administrative items to take care of. A reminder to anyone who has joined anonymously that if you're looking for CPD credits, please do send an email to the address that's in the notes section to this presentation. And also, if you have any questions as we're going through, feel free to just pop them into the Q&A feature and we'll have a time to respond to those questions at the end of our presentation. So this morning, what we propose to do is take the first hour or so to chat about transaction structuring in the context of a case study. I will be taking us through the facts of our case study and running through the asset sale issues, and my partner Anthony Strawson will then be running through some share sale considerations. Then the balance of our presentation will turn the floor over to our partner Matthew Kramer, who will discuss our current topic for today, which is some recent cases of interest. So getting right to it, let's turn to the facts of our case study. So what we'll think about is a purchaser that is a Canadian public corporation that is also a taxable Canadian corporation. It is carrying on a widget business, very creative, we know, and it expects to be taxable in the next 5 years. Its acquisition and business growth strategy includes acquiring the competing widget business of Target. Target, on the other hand, is also a Canadian public corporation and a TCC. It is carrying on a widget and hammer business in two different divisions, Division A and Division B, and it has significant tax attributes, including UCC pools, non-capital losses, and SR&ED expenditures and ITCs from some research that it did both for its widget business and for the hammer division of that business. It also has some non-capital losses, notably from both the widget division and the hammer division. As a bit of an aside, if we look, the hammer division losses date back to 2010. And if we think about whether or not we're going to value those non-capital losses in the hands of the purchaser, you might think, well, the 2010 non-capital losses are not going to expire. Sorry, just one moment. It has come to my attention that my slides are not moving, so I am going to try and fix that. That's the agenda. Everyone has those. We've run through the facts. So back to the non-capital losses of the hammer division. The hammer division has non-capital losses dating back from 2010, and you would traditionally think that those would expire in 2030. And if you're looking from the perspective of the purchaser, we have an expectation that they'll be taxable 5 years from now. So you would typically think that, okay, that probably has some value in the hands of the purchaser, but you would also, as part of your due diligence, want to look at whether or not Target has some additional year ends that might cause those non-capital losses to expire a bit earlier. What we also know about Target is that there is an inventory buildup as a result of depressed prices in the last few years, and also that there were some faulty widgets that were recalled in 2018 and 2019. And just a question that's popped up, people are asking whether or not the slides are still being advanced. Just to the extent that anyone missed anything, we will be circulating the slides after the presentation. So this morning we'll talk through two potential scenarios, a scenario where the purchaser is acquiring the Target's assets and a scenario where the purchaser is acquiring the Target's shares. Of course, there are a number of other hybrid transactions that you could implement to sort of bridge the gap between the purchaser and the vendor, particularly in a privately held Target. So in that situation, you might be able to actually sell some assets, pay some capital dividends, and then sell the rest of the shares to the public entity. There are also a number of possible transactions dealing with joint ventures and partnerships, but we don't propose to discuss those this morning. So this is a slide that both Brett and Kyle discussed in the first lecture of this series, just talking about the usual preferences of a purchaser and a target. So a purchaser will generally prefer to purchase assets because it will have higher deductible, depreciable property costs, potentially higher resource property pools, and mainly avoid the risk of assuming undisclosed liabilities. It also has the opportunity to just select certain assets of the vendor, whereas Target will typically prefer to sell shares because it won't have to think about a number of things, including potential recapture and income, and it possibly also could qualify for a capital gains exemption if Target, rather than being a pubco, is a private corporation. There are certain circumstances where a purchaser may prefer to purchase shares. For example, if the target has significant unused losses or other tax attributes, or if there are significant indirect costs of acquisition. And you may also be in a scenario where Target is indifferent to whether it's selling shares or assets and might actually prefer assets. For example, if you have a situation where you have a private corporation that has a significant capital dividend account. So let's turn now to our case study. So the purchaser is going to acquire all of Target's assets, or it's going to acquire only the Division A assets. Recall that our purchaser is in the widget business, and it's really only interested in the Division A assets. So things that the purchaser and the target will have to negotiate and think about are what is the pricing for the Division A assets only, and how do you allocate the purchase price as between all of the different assets that are being purchased. You can also think about whether or not there might be an assumption of liabilities for partial payment of the purchase price, and also what level of shareholder approval is required. So from Target's perspective, for example, if the Division A assets really just form a small portion of the overall business of Target, it's possible that they might be able to conclude and approve the sale without going through the different levels of shareholder approval that are required. Ultimately, what shareholder approval is required will depend on the materiality of the transaction. So Target would be thinking about, well, in terms of pricing, if it's actually interested in selling all of its assets, are there different purchasers for its Hammer division assets only? If it's going to sell all of its assets, it might also be in a situation where it's more likely to realize a terminal loss or a recapture, assuming that both the widget and the Hammer division assets are one business. It's possible that if they're only selling the widget division assets, that terminal loss and recapture might not arise. From the purchaser's perspective, it might be worried about potential liabilities relating to the non-keeper Hammer assets and whether or not it wants to be on title for those Hammer assets at all. Our parties will also have to negotiate the purchase price allocation, with the purchaser generally preferring allocations that are diametrically opposed to those preferred by the target. So the purchaser generally prefers allocation first to inventory, then to depreciable capital property with a high CCA rate, then to depreciable capital property with a low CCA rate, and finally to non-depreciable capital property. And this is, of course, based on the ability for the purchaser to deduct the purchase price cost. Target, on the other hand, will generally prefer first allocation to non-depreciable capital property, then to depreciable capital property with little or no CCA recapture, then to depreciable capital property with CCA recapture, and then finally to inventory, again, because the different pieces will have different income inclusion ramifications to Target. So is there a scope to consider purchase price allocation that will benefit the purchaser? Well, Target might be indifferent to the purchase price allocation because it has substantial non-capital losses, shred expenditure pools, and ITCs. In this case, it might be possible to simply go with whatever the purchaser prefers for its purchase price allocation. However, that being the case, there's a risk that Section 68 might apply to reallocate the purchase price to what might be considered to be reasonably regarded as being the consideration for the disposition. So just something to keep in mind if you are not choosing a purchase price allocation that is exactly commercial. Target and purchaser might also think about whether or not there's an opportunity for a tax-deferred transaction. For example, Target could, instead of selling its shares for cash, instead roll the assets to purchaser in exchange for shares of the purchaser entity. If it is doing so, however, keep in mind that the purchaser will be unlikely to agree to low cost for Division B assets if ultimately it's going to acquire the Division B assets. For Target, on the other hand, if it's only selling its Division A assets, we'll have to think about, well, what is the character of those shares in the hands of Target, the purchaser shares that are issued to Target? Because presumably, if Target's going to carry on with its Hammer division business, it will want to liquidate its purchaser shares, probably in the market, potentially subject to a lockup agreement between purchaser and Target that will set out the timing at which it can sell its purchaser shares. The other thing to keep in mind for Target is whether or not it might qualify for the deeming rule under Section 54.2 that generally applies if the purchaser is selling all of its assets or all or substantially all of the assets used in an active business in exchange for shares. So if it were to sell all of its Division A and Division B business assets, then I think you clearly qualify for that deeming rule in the Act. However, even if it's only to sell its Division A assets and there's some uncertainty as to whether Division A and Division B are all operating as one business or two separate businesses, you might still qualify for considering those shares to be held on capital account based on more common law principles. Another thing to keep in mind too is that if all of the assets of Target are sold, then chances are it will make little sense for a public entity to carry on in this way, as you wouldn't want to have two public issuers. However, if Target is a private entity and if it's acquiring more than 10% of the shares of purchaser, it's possible that this may be an efficient holding structure, particularly if the purchaser is a dividend-paying entity where you might qualify as being connected to Target, and therefore there might be minimal Part 4 tax or no Part 4 tax payable. Okay, so let's consider the situation then where purchaser and Target agree that purchaser is going to buy all of the assets of Target for cash, but because purchaser isn't interested in the Hammer division assets, it's then going to sell those assets to a third party in a second step. So when might this type of scenario arise? You could simply have Target enter into a three-party purchase and sale agreement where both purchaser and third party are the purchasers and Target is the vendor. Typically, you would have the third party prearranged in any event, but you might have a unique scenario where Target might prefer to only negotiate with one purchaser. It might be easier to negotiate the covenants with just one particular purchaser as opposed to two different purchasers. There might just be different agreement terms that make sense for the sale of the widget business assets as opposed to the Hammer division assets. It might be in a CCAA context, or Target might just have a bad history dealing with third party and just doesn't want to enter into that negotiation. So what are the consequences to the purchaser? Well, the purchaser consequences are simple, which is probably why you would look at a Target asset purchase, in that it's depreciable property that it acquires from Target. It'll just have a UCC pool addition equal to the fair market value consideration paid for those depreciable property assets. and the cost of all of its other properties will simply be equal to the purchase price that it paid. Purchaser might consider using an acquire co if it is concerned about liability related to the Hammer division assets. It might also choose to use the acquire co to run its division related to the widget business on a go-forward business, or on a go-forward basis rather, particularly if purchaser has other businesses and perhaps it is thinking about selling the widget business down the road. Having an acquire co in place might be able to set a future purchaser up for a bump transaction, which Anthony will discuss in the second half of our presentation this morning. And depending on the relative expected profitability as between purchaser and acquire co, you could fund the acquisition either by way of debt or by way of equity. From the perspective of Target, its exact tax consequences will of course depend on the purchase price allocation. If there's little purchase price that is allocated to the depreciable property, we might be in a situation where it has a potential terminal loss. But if a lot is allocated there, then we might be in a situation where it has potential recapture. For inventory, any gain to the target will be included on income account, and the cash that is in target at the end of the day will have to be distributed to its shareholders, assuming that it won't otherwise be invested by Target in a different business venture or in expanding its other existing businesses if it has any. So the cash to the shareholders of a public entity will generally be considered to be dividends, even if it is a puck reduction and a return of capital. But in this fact situation, you might be able to fit within the more specific rules in subsection 84.4.1, which allows you to return capital if your proceeds are from a transaction that is outside the ordinary course of business, and if you return that capital within 24 months. A couple potential elections to keep in mind as between the purchaser and the target are the accounts receivable election. Whether or not that's available will depend a little bit on whether or not your division A and B assets of target are really one business or two separate businesses. To the extent that amounts were previously included in target's income under paragraph 21A, there might be a prepaid receipts election that's available, and also your GST election under section 167 of the Excise Tax Act, which does not hinge on whether or not Target's division A and B assets are one business or two separate businesses, but rather asks the question of whether all or substantially all of the assets necessary for recipients to carry on a business have been sold. So if we're looking at the purchase of the target assets, what are the main advantages? Well, the main advantage is that the purchaser avoids the risk of assuming undisclosed liabilities of target, and it possibly has higher deductible costs of the property acquired. There's also generally fewer items to negotiate relative to the share purchase. There are a number of disadvantages, though, including conveyance requirements, regulatory notices, consents, licensing, transfer taxes, GST, PST, HST, land transfer taxes, and perhaps most notably, Target's non-capital losses and other tax pools, including shred expenditure pools, ITCs. These will all be separated from the income earning properties of Target, making them potentially less valuable. There's also a risk, because there's such significant pools, that you might have a Section 68 reallocation of the purchase price. So with that, the question is, well, is there something better we can do? And we'll pause for a moment and hand it over to my partner, Anthony Strawson, who will determine whether or not we can do better with a share sale.
So just as Sarah mentioned, so we'll flip gears here a little bit. We're going to continue on with our case study example and the facts, but we'll look at it now through the lens of a potential share transaction and see what that might look like. Just starting, again, we'll continue with the same facts, the same case study, but we'll layer on one additional little wrinkle for reasons that we'll talk about later. and add in that the target has some public debt outstanding, US dollar denominated public debt outstanding, with an inherent foreign exchange gain that target would realize if that debt were to be repaid. So in our first installment in this series, Kyle and Brett had talked previously about some of the different mechanics of how we can undertake a transaction, takeover bid, plan of arrangement, merger. Just a reminder that those different alternatives do exist. So we won't go through those in any detail here today, but just a reminder that there are, from a securities perspective, there are a lot of different tools in the toolkit. Each of them are different. Each of them have different securities law implications, potentially dramatically different tax implications. The plan of arrangement in particular has really wide scope to be all sorts of different things. So just keep that in mind. When we're looking at a share transaction, usually the first and the most critical tax issue that we want to wrestle to the ground is the acquisition of control. Is there one, first of all, and then what are the implications of there being one? And when the Income Tax Act refers to control, in most instances, it's talking about de jure control, which is really just a fancy or perhaps obnoxious way of saying legal control, which means the ability to elect the board, the majority of the board. So owning shares that are entitled to 51% of the votes typically results in having legal control. That's not always the case, and we'll talk about some reasons why that's not the case from an income tax perspective because of specific rules that expand the scope of that. It's also potentially not the case where there are things like a unanimous shareholders agreement that can override the ability to appoint the board or what the board can do and take that control out of the hands of the voting shareholders or alter it in some fashion. But as a general rule of thumb, that's a very good starting point, is to look at the number of voting shares and apply sort of a mathematical test to it. So turning now to sort of the consequences of an acquisition of control. So if there is an acquisition of control of the target, in this case, we have a loss restriction event. And the key implication of that is that we engage what's often referred to as the same or similar business test, loss streaming rule in 111.5. And that, same or similar business language, I think is a bit of a helpful way to understand the rule. It's probably a little bit misleading too, and we'll talk about what that means just briefly here. So if that rule is engaged, the first question to ask is, looking at the losses of the target, are they losses from a business, or are they losses from property, or are they capital losses? If they are losses from property, so for example, perhaps a pure holding company that doesn't carry on any business at all has generated some expenses, maybe 21E type expenses, or maybe some interest expense. Some things like that potentially give rise to losses from property, but not from a business. If that's the case, those losses expire on the acquisition control, they're just gone. Similarly, capital losses expire on the acquisition control and they're just gone. But if, in looking at the non-capital losses, you can determine that, no, those arose from a business, then you kind of go to the next stage of the analysis, which is to ask yourself, is that business, the lost business, still carried on after the acquisition control? And is it carried on for profit or with a reasonable expectation of profit? Because if the lost business has actually stopped, it's no longer being carried on, then again, the losses are toast. They don't survive the acquisition control. If you get through that hurdle, so it's from a business, the business is still being carried on, for profit or with a reasonable expectation of profit, then the limitation is that you can deduct those losses against income from that business, so from the lost business, which sort of begs the question of how broadly you can define the business, or from another business that involves the sale or provision of similar property or similar services. That's that same or similar business kind of language that we see creep into the description of the test. So just to recap, property losses expire, capital losses expire, business losses may or may not be usable post-acquisition of control. If you're in a situation where some losses are being wiped out, then it's very useful to take a look at the designation rule in 111.4e, which allows you to get a little bit of value out of otherwise expiring and kind of useless losses. And what those designations do is they allow you to step up the tax cost of depreciable or non-depreciable property, triggering potentially recapture or capital gains, which you can then shelter with those property losses, for example, or capital losses that otherwise are not going to do you any good post-acquisition control. So you step up some tax cost. Another big implication of an acquisition control and engaging these sort of loss streaming rules is write-downs. So in the case of depreciable property, if the UCC of a particular class exceeds the value of all of the property in that class, then there's a forced write-down that triggers a loss, and then that loss is then subject to those streaming rules that we just talked about. Similarly, non-depreciable capital property, if ACV exceeds value, there's a forced write-down, triggers a capital loss that then is subject to the loss streaming rules. Tying back into that additional fact that we added earlier on to our case study, where our target has this US dollar denominated debt outstanding, it's got a foreign exchange loss. On an acquisition control, 111.12, even though that debt is an obligation to the target, it's not property to the target. 111.12 says that foreign exchange loss is also deemed to be realized, and again is essentially wiped out, subject to being able to make some hay with that designation that we just talked about. Exempt surplus balances, same thing, potentially a write-down if they exceed value. Deemed year ends is another important implication of the acquisition of control. The deemed year end, there is a deemed year end for target, the Canadian resident subsidiaries. The default approach, a little bit counterintuitively perhaps, is that the deemed year end occurs at the beginning of the day, unless you make an election under 256 sub 9 to have it occur at the time it actually occurs. And sometimes it's useful to make that election, sometimes it is useful to not make that election, depending on the other transactions that are going on. So be aware of that one. Okay, so that's acquisition of control. Let's talk now just a little bit about some of the opportunities that sometimes exist to structure to not have an acquisition of control. And in our case study, where we're dealing with two public companies, public purchaser, public target, this is almost certainly going to be driven by commercial reality. In other movies where there might be a private player involved, there may be greater scope to structure an outcome where you can avoid an acquisition of control. But in the public context, there's generally going to be a lot less scope for that. But let's go through some examples of where there may not be an acquisition of control on a share transaction. First example is an amalgamation of equals. So the Income Tax Act has a set of rules that, in general, if you amalgamate unrelated companies, there's an acquisition of control. But if the companies are sort of equal in size, you can amalgamate both without having an acquisition of control of either. So that's something to keep in mind. Another potential scenario that can arise is in situations where it is commercially feasible to pick up less than 50% of the votes, so staying below that de jure control concept that we talked about, and also staying below 75% of the value. And the reason why that 75% of value concept is relevant is because of an anti-avoidance rule in 256.1 that says even if you've stayed below 50% of the votes, if you've gone above 75% of the value, we're going to treat you as though you've acquired control in any event. And then just to make it a little bit more vague, if it's reasonable to consider that one of the reasons of a transaction is to hold less than 75%, you're basically deemed to have clicked over that 75% threshold anyway. So that's a tricky one to get super confident on where you land sometimes. Any time we're dealing with situations where we're trying to avoid an acquisition of control, and often even when we're not. But we've got implications of an acquisition of control that are material. It introduces issues around uncertainty, risk, pricing, and valuation. So what are the pools worth? What are the risks associated with those pools with or without an acquisition of control? If we're trying to avoid an acquisition of control, how much exposure is there under the GAR? And a lot of that is a moving target. The legislation's been shifting over the past number of years, cases keep coming out. So it's a bit of a moving target. And then the final implication, and this is a good segue, is unless you have an acquisition control, there's no scope to do an 88.1D bump. Okay, great segue, I think. So the 88.1D bump. So after sort of the acquisition control and loss streaming considerations from that, often the second most important thing to start thinking about is a bump. And the 88.1D bump is an interesting rule. It allows you to take the acquisition cost of the target and essentially push that cost onto the ACV of certain property owned by the target. But it's not automatic. It doesn't work for a lot of property. And there are all sorts of traps and exceptions, some of which we'll talk about. So it's an interesting one. It's a tricky one, but it's important. So what can you bump? What's bumpable property? So first and foremost, it's non-depreciable capital property. That's the only thing that you can potentially bump. So the big examples there are shares, Canadian companies, foreign companies, but shares are usually bumpable. And land may be bumpable, some other types of property may be bumpable, but those are the big things usually to look out for. Partnership interests are not fully bumpable anymore. Used to be a great opportunity to bump partnership interests. That's severely curtailed now. You can only bump partnership interests to the extent the gain on the partnership interest is not attributable to things that themselves are not bumpable. So depreciable property, resource property, inventory, none of those things are directly bumpable. And if those things have given rise to an accrued gain on a partnership interest, to that extent, you can't bump the partnership interest either. So because of all of that, because of the really narrow scope of what you can bump, it's very common to package assets into subsidiaries prior to the acquisition of control so that they're in a bumpable state. Without that packaging, often the assets are not in the right form, they're not held in the right way, and you don't have the opportunity to bump. That, of course, presumes that you've got at least some degree of friendliness between the purchaser and the target so that there's a willingness to help package assets and achieve the best outcome for all parties. On the bump, so we've talked about what is bumpable property. We'll run through now over the next couple of slides sort of the key bump rules and principles that are worth keeping in mind. The first key principle is sort of a continuity of ownership theory. And the theory of this principle is that you can't put property into the target after the acquisition of control and bump that property. In other words, the bump is limited to property that was held by the target at the time of the acquisition of control. That's what you're allowed to bump, not things that come into the fold after the fact. That's the first principle. The second principle is you can't combine a butterfly, a 55(3)(b) type transaction with a bump. The third principle is no stuffing. And this is a little bit similar to that first one, but different. And the concept of this one is the parent group is not permitted to put property into the target group so that property that really originated in the purchaser group can be bumped. That's not allowed. That violates this anti-stuffing rule. And again, the theory is the bump is supposed to allow you to take the purchase price cost, push that down onto target assets. And so if you stuff things into it ahead of time, you'd be in violation of that theory, that principle. The principle itself, I think, is relatively straightforward. The reality is pretty complex because there are you know, a little bit of, you know, not necessarily that weird, but fact patterns that have arisen over time that finance has responded to with specific rules that aren't quite drafted as perfectly as perhaps they could be. In particular, 88.1.7 is a rule that deals with situations where you know, the parent, for example, the purchaser entity, acquireco, doesn't coexist with the target group, and so without a specific rule, it might be possible to actually stuff and not violate this anti-stuffing rule technically. So they brought in another rule to sort of deal with that situation, then causes some other potential issues around packaging. And so it's just an example of how these rules in practice get really complex quickly, but the theory is no stuffing. And then the final sort of key rules, principles to talk about are bump denial rules. These also were initially introduced, or their initial incarnation was to deal with a relatively narrow situation of preventing what's often referred to as backdoor butterflies. And so a butterfly transaction, a 55(3)(b) division, very complex transaction subject to lots of limitations and restrictions on what you can do. Some of the restrictions include you can't have an acquisition of control as part of the butterfly, and you can't have essentially significant dispositions of property to unrelated persons as part of the butterfly. Well, if we didn't have any sort of arms around the bump rules, it would be possible to get around that, those restrictions and butterfly rules by using the bump formula. For example, a seller shares to a third party winds up, bumps something, and then sells the one thing back to the original shareholder. So effectively a backdoor butterfly. So these rules, these bump denial rules, are originally intended to prevent that problem, and it's helpful, I think, to view them in that light when trying to understand what should or should not be caught. But the reality is that they are drafted really, really broadly, and so they can catch all sorts of situations that don't really have anything to do with a backdoor butterfly. These rules, they refer to prohibited persons acquiring prohibited property as part of the series. Sometimes we'll describe that as bad people acquiring bad property. And the concept really at its core is big shareholders, so shareholders with 10% or more, or some aggregations adding up to 10% or more, those are generally bad people. If they acquire property distributed by the target on the windup, or anything substituted for that, which in and of itself is really broad. There are lots of look-through rules and deeming rules that make the concept of substituted property a lot more broad than you might think. If that happens as part of the series, then you've violated the bump. Okay, so that's, I think, enough on the bump. Just shifting gears now to some of the rollover type of transactions. There are a couple of main ones that we see very frequently to provide a rollover for target shareholders. The first one, and this is by far the most common because it's automatic and it's easy, is an 85.1 share-for-share exchange. As I said, this is fully automated, so there's no election required, but the limitation on it is that you can't have any share consideration in order for the rule to be complied with. Under a plan of arrangement, for example, it's not that unusual to structure the transaction in a way that allows for 85.1 to be complied with while providing for some other consideration in different ways. But just be aware that 85.1 has that limitation. The second type of rollover rule that we see less often in a public context, but it's still pretty common, is 85 sub 1. And 85 sub 1 has the big advantage of accommodating cash and other non-share consideration boot, has the huge disadvantage in a public context of requiring an election, a joint election. And so I'm sure for some people watching the webcast, you've gone through that experience in some situations where an election, 85 sub 1 election, was offered to the public. And sometimes that goes reasonably smoothly because nobody takes you up on the offer. Sometimes a lot of people do, and it's a lot of work. So it can be very labor intensive and often is not anyone's first choice. And then the final point just to note is that 85.1, 85 sub 1, obviously those are Canadian rules. They provide a rollover for Canadian purposes. They don't speak to what the consequences for any non-Canadian taxpayers might be under foreign law. Another type of rollover type transaction is an amalgamation. And most amalgamations that you will come across are amalgamations that are described in 87 sub 1 of the Income Tax Act. But that's not a given. So it's always worthwhile taking a look at the actual transaction mechanics of the amalgamation if you're looking at one to make sure that it actually is described in 87 sub 1. So for example, if a shareholder of a predecessor corporation is actually being cashed out on the amalgamation, well, you're kicked out of it. You're not in 87 sub 1, no rollover, but it's still amalgamation. So it's worth. Sorry, it's still an amalgamation for corporate securities law purposes, just not as defined in 87. So anyway, it's worth looking at that, but most amalgamations fit within 87 sub 1, and it's a rollover. The second kind of an amalgamation that we see, it's much less common, also a rollover. Instead of shareholders of purchaser and shareholder of target acquiring shares of Amalco, which is sort of your basic amalgamation, on this kind of an amalgamation, the shareholders of Target receive shares of purchaser on the amalgamation of Target and Subco. So there's three parties to the amalgamation. There's purchaser, there's a subsidiary of purchaser called Subco, and then there's the target. And because there's the three parties, it's called a triangular amalgamation. Final point I want to talk before just kind of wrapping up some of this stuff is an acquire co. So often you'll see in a share transaction reference to an acquire co or acquisition co. There are a number of reasons why you might have an acquire co. The first reason why you might have an acquire co is it allows you to have high puck in addition to high ACB. That can be useful. If you just go out and buy Target, you kind of inherit the old puck of the Target shares, whatever that may happen to be. But with an acquire co, you can get a better result subject to how you've actually acquired those shares. For example, if it's under 85.1 and what happens there. The second reason why you might see an acquire co is to get your debt in the right spot and to get interest deductions in the right spot. So in this example, let's assume that the purchaser is going to borrow a bunch of money from the bank, going to use that money to fund acquire co, and then acquire co is going to go buy Target. Well, you'd like to have the interest expense on the bank debt presumably available to shelter the income from the Target. And so by using an acquire co, you could loan the money back to back from the bank down to purchaser to acquire co, and then following the acquisition of control, squeeze Target and acquire co together through a wind up or an amalgamation of Target. So then we've got interest deduction where we want it. Third reason why you might see an acquire co is to get a bump. You need to have an acquire co or at least some acquisition vehicle that you can wind Target into, and that isn't necessarily the parent company. If you want to have a sort of a pure parent holding company, don't necessarily want to have Target wound up into it. And then the final reason that we see sometimes have an acquire co is where the target is a private company or perhaps was a private company or bought some private companies. For whatever reason, there's a low rate income pool problem within the target group that you want to do your best to avoid sort of tainting the purchaser group. So acquire co potentially facilitates that. So just to wrap it up, and then we'll move off to sort of a case study around current cases. Let's assume that on doing some further due diligence, purchaser just makes the conclusion that they really want to keep the division A, they're going to sell division B, and they've got a third party lined up to sell or to buy division B. Unfortunately, the major shareholders of the third party are also major shareholders of purchaser. Because of that, we can't bump. That would violate the one of the bump rules we talked about. So the bump is offside. There's not going to be a bunch of debt being borrowed, let's assume. And so we don't really need an acquire co. It's going to be just a straight acquisition by purchaser of Target. That's what we're going to do. Target will turn around and sell its division B to the third party. Target has enough losses, we've determined, that it can shelter the gains on that sale and in fact step them up, step things up and soak up its losses through the 111 for designations that we talked about and the loss streaming rules. So we can do actually a pretty simple, straightforward transaction here to get the desired result on these facts. So with that, I will pass the podium along to Matt Kramer, my partner, to give us a review of some current cases.
For those of you that I don't know, my name is Matthew Kramer, and this morning I'm going to review two decisions in some detail: the Bank of Montreal cost decision and a Dow Chemical transfer pricing Rule 58 question about jurisdiction. But before I do, as you all know, the Supreme Court of Canada recently denied the Crown's application for leave in the Cameco decision, and Chris Montez will be speaking about that in much more detail next session, so we won't speak about that one today. Starting with the Bank of Montreal cost decision. So this was a cost decision that involved a settlement offer that satisfied Rule 147 3.1. And just for some judicial history, the Tax Court of Canada found that the GAR did not apply in these circumstances and allowed the taxpayers' appeal with costs. The Crown appealed to the Federal Court of Appeal, and that appeal was dismissed. And then we went back to the tax court to figure out costs, and that's what this decision is really about. But before we get into the cost portion of it, let's just review what the actual tax dispute between the parties was. So this was a GAR decision that involved pre-amendment subsection 39.2 and subsection 112 3.1. So it was a modified tower structure, and when they're setting up their structure, the taxpayer had some concern that it would realize a capital gain and an offsetting capital loss, but that the capital loss would be reduced by subsection 112 3.1. And really, the question was about what is the breadth of subsection 39.2. And interpreted really broadly, you would say at the time, subsection 39.2 deemed the foreign exchange loss on the disposition of shares to be a disposition of currency. And because it's a disposition of currency, subsection 112 3.1 wouldn't apply, because subsection 112 3.1 only applies on a disposition of shares. But interpreted more narrowly, there was some concern that 112 3.1 would apply to reduce the capital loss on the disposition of shares. So in order to sort of avoid that risk and manage that risk, the taxpayer decided to issue a second class of shares and pay dividends on that second class of shares. So the class of shares on which the loss was realized wouldn't be the same class of shares on which dividends were paid. And because 112 3.1 operates on a class-by-class basis, that would avoid the application of 112 3.1. The Crown argued that this circumvented the application of 112 3.1 and by issuing and paying dividends on a second class of shares, and thereby avoided the reduction of the FX capital loss. At the tax court, the judge found that subsection 39.2 applied to the capital loss, and that it would have applied to the capital loss regardless of the issuance and the payment of dividends on a second class of shares. So subsection 39.2 deemed the loss to be from a disposition of currency and not from shares, and 112 3.1 didn't apply and would not have applied even if the taxpayer had not modified its structure to issue that second class of shares and pay dividends on that second class of shares. Because 112 3.1 would not have applied regardless of this transaction, there was no tax benefit that resulted from the impugned transaction. The result would have been the same absent that impugned transaction. So the court found there was no tax benefit, and it was unnecessary to carry on and engage in a misuse or abuse analysis. The Federal Court of Appeal agreed that there was no tax benefit, and an interesting little aspect of the case is that they said the finding that there was no tax benefit was a finding of law, and that meant that at the Federal Court of Appeal, the standard of review was correctness. But the Federal Court of Appeal decided the tax court was correct and upheld the decision that there was no tax benefit. So the parties were unable to agree to cost and came back in front of the Tax Court of Canada judge, same judge that heard that made the decision on the substance of the matter, and argued about costs. And in this case, the taxpayer had made a settlement offer and had obtained judgment on as favorable or more favorable terms than they offered to settle. So this engaged the application of Rule 147 3.1. So looking at 147 3.1, where a party makes an offer of settlement, where an appellant makes an offer of settlement and obtains judgment as favorable, more favorable, then from the date of the settlement offer forward, they're entitled to substantial indemnity costs. And prior to that date of offer, they're entitled to party and party costs. In order to qualify for the enhanced costs awards under 147 3.1, you have to satisfy Rule 147 3.3. So the offer has to be in writing, has to be served no earlier than 30 days after the close of pleadings, and at least 90 days before the commencement of the hearing. It can't be withdrawn, and it must not expire earlier than 30 days before the commencement of the hearing. And as we saw in Rule 3.1, it entitles you to substantial indemnity costs, and that means 80% of solicitor and client actual costs incurred. So it can be a big number. In this case, the Crown argued that the parties agreed that the settlement offer met the requirements of subsection 147 or Rule 147 3.3. And they agreed that the taxpayer was entitled to substantial indemnity costs from the date of the offer forward. And then they were arguing about, what about that pre-offer period? And the Crown said that in the pre-offer period, the taxpayer was only entitled to costs on a tariff basis. And on a tariff basis, there's a tariff after the rules, and it lays out how many dollars you get for each step of the proceedings, and it's very limited. It's a very, very small number compared to the actual costs incurred. And the Crown said, no, all you get in that pre-offer period is party and party costs on a tariff basis. And the court said, no, the fact that you get substantial indemnity costs post-settlement offer, doesn't in any way limit our discretion in terms of the pre-settlement offer period. And we're not limited to the tariff costs. In fact, there's a number of factors that are set out in Rule 147.3, and we get to consider each of those factors as we do in every other circumstance. And so in this case, after consideration of all the relevant factors, the taxpayer got costs for the pre-settlement offer period that amounted to 35% of the actual costs incurred, and then substantial indemnity costs, 80% of their actual costs for the post-settlement offer period. Okay, moving on to the Dow Chemical decision. So this was an interesting decision that I had reason to review recently that involved the transfer pricing rules. And the taxpayer was reassessed under the transfer pricing rules, and that resulted in an increase to the taxpayer's income. But the taxpayer argued that certain other downward transfer pricing adjustments should be made. So looking at the kind of legislative framework here, subsection 247.2 mandates both upward and downward transfer pricing adjustments. It doesn't make the distinction between them. But subsection 247.10 provides that no downward transfer pricing adjustment may be made unless, in the opinion of the minister, the circumstances are such that it would be appropriate that the adjustment be made. So it provides for some discretion for the minister to determine whether it's appropriate in the circumstances to make this downward adjustment. And in this case, the minister exercised her discretion and determined that the downward adjustment was not appropriate in the circumstances. So the question arose, what's the appropriate way to review and challenge the exercise of the minister's discretion under 247 sub 10? So the parties, the taxpayer objected and appealed, but they asked for a Rule 58 determination in this case. So a Rule 58 determination is where you go to the court and say we would like a determination on this narrow question of law. Rather than a hearing on all of the issues in dispute, first we'd like to determine this question of law. And it was a really sensible approach in this case because if they're in the wrong forum, if they're in the wrong court, and they ought to be reviewing the minister's exercise of discretion in federal court under a judicial review process, well, then it'd be a real waste of resources to go ahead and hear the entire, all the issues in dispute and all the evidence. Let's figure this narrow question out first, and then we'll move forward with the rest of the dispute. So the Crown argued that any review of ministers' discretion is beyond the jurisdiction of the tax court, and that judicial review in federal court is the appropriate forum. And the taxpayer argued that the minister's decision is reflected in an assessment, and the proper mechanism to dispute an assessment is an objection and appeal. And the tax court judge hearing this Rule 58 application really looked at it from a number of different perspectives and considered it from a number of different perspectives. I've sort of cherry picked the ones that I found most compelling or most interesting to share with you here today. So the first thing, one of the things the judge did is looked at the jurisdictions that are provided to each of the courts under their legislation. So the Tax Court of Canada Act provides the tax court with exclusive original jurisdiction to hear and determine references and appeals on matters arising under the Income Tax Act when provided for in the Income Tax Act. And the Federal Courts Act provides the federal court jurisdiction to judicially review decisions or actions of a minister having, exercising, or purporting to exercise jurisdictions or powers conferred under an act of parliament, unless an act of parliament expressly provides for appeal to another court or body. So the federal court has sort of a residual jurisdiction to hear these things, but if there's another act out there that expressly provides for appeal to another court or body, then that should win out. And so the judge, from this perspective, said the determination of whether an assessment is correct is explicitly provided for in the Tax Court of Canada in the Income Tax Act, and so the federal court's sort of residual jurisdiction shouldn't come to play in this circumstance. Another perspective that the tax court judge took was to say applications for judicial review are often dismissed on the basis that it amounts to an attack on the validity or correctness of an assessment, and that's the exclusive jurisdiction of the Tax Court of Canada, and so the federal court judicial review application gets bounced on that basis. And that suggested that because this decision not to make a downward transfer pricing adjustment is reflected in an assessment, that it bears on the correctness of that assessment, and that the federal court should bounce that judicial review application. The tax court judge then considered what kind of remedies can each of these courts provide, and the federal court in this, when it hears a judicial review application, typically will just their remedy is to say go back and reconsider, make the decision again. And the federal court doesn't have the power to vary, set aside, or vacate an assessment, where the tax court can consider the matter and refer the assessment back to the minister for reconsideration and reassessment, which seems like a much more satisfying remedy in these circumstances where the exercise of discretion resulted in an assessment. So the Crown argued that all ministers' discretions should be subject to judicial review in federal court. And the tax court judge said, no, there's three different categories and buckets of discretions that the minister has under the Income Tax Act. And we should look at each of these different buckets and consider them differently. And so there's discretions to waive interest, penalties, or taxes, the kind of the fairness provisions. There's discretions to waive compliance with timelines, filing requirements, or decide whether to assess. And then finally, there's a third bucket, which are discretions directly related to computations of income, taxable income, or tax. And the judge said subsection 247.10 discretion falls into that third bucket. It really comes down to computations of income, taxable income, or tax. And in this case, the exercise of the discretion and the resulting assessment are inextricably linked, and the determination goes to the correctness of the assessment. So kind of to sum up the decision, the judge said 247.2 mandates both upward and downward transfer pricing adjustments. So the discretion under subsection 247.10 must be exercised before income and resulting tax liability can be assessed. If the discretion is not properly exercised, the assessment is not correct in law. And so since the Tax Court of Canada has jurisdiction to determine if an assessment is correct, so the tax court has jurisdiction to consider if discretion under 247.10 was properly exercised. And so that was their conclusion, that the tax court was the correct place for this. So that's all we have here today. There are a couple of questions up here, and I'll step aside and let Anthony take them, and then give you a reminder that for CPD credits, send an email to us, and we're also very happy to answer any other questions that come up later by email or phone.
All right, thanks, Matt. So yeah, actually just one question. I think the other was a technical one that hopefully was resolved, or this was a really boring presentation for people. And so I'm going to hope that the first one was resolved. So the only question so far, and as Matt said, we're happy to take questions. We're kind of nerdy that way. So if you have anything that you want to ask, you can pop it in now or email us, call us. We're happy to chat about anything. So the one question that we've got is just, what is PUC? Fair question. What is PUC? So PUC, paid up capital, is probably the way I would describe it or think of it is the ability to pay amounts back to shareholders without a dividend. So it's the amount that you can return as a corporation to shareholders without giving rise to a dividend, generally. There's even that constraint is a little bit more narrowed for public companies, but that's kind of what that means. That is sometimes equal to ACB, particularly in private situations, but even then it's not always, and it's never equal to ACB pretty much in a public context. So that's what PUC is. Hope that answers that question. Again, if anything else comes up, please do reach out. Hope you have a wonderful day. Thanks all.